Hello friends, very good and enlightening good evening greetings to all of you. So here I, Kunal Nagpal, once again welcome you back to this great economic forum. Dear friends, there is actually a very good news which I wish to share with you. That is, among the gloomy economic environment as a whole, India is still shining, and the Indian economy is looking like a bright spot in the dark room. Dark room because the overall global economy is in the dark scenario as of now. Even some of the developed nations are basically going through the tough phase, which we can call as global recession. So here it goes. First of all, we are going to have the background of the overall gloomy global economic scenario, and then we will try to highlight that how India's economic parameters are standing out amongst this existing scenario. We have been discussing very positive factors about the Indian economy due to the ever dynamic leadership of our country. Now again, there are some important highlights about the Indian economy. So let's begin. The global recession risks keep on rising as the central banks across the globe keep raising their rates. That is the repo rates. The major central banks this week signaled their willingness to basically counter the global recession in 2023, as they promised to raise the borrowing costs further in their ongoing battle against high inflation. After each increased rates by a half percentage point, the heads of the Federal Reserve, the European Central Bank, that is the ECB, and the Bank of England all said more increases are likely next year, even as they acknowledged that their economies were weakening. The mounting risk is that an even greater tightening of the monetary policy on top of the biggest squeeze in 4 decades will undermine demand and hiring so much that it forces the world economy to slump next year as soon as the pandemic-driven contraction happens. We are just on the edge of a global recession, said Mr. Ethan Harris, head of the Global Economics Research at Bank of America Corp. The fastest inflation rate since the 1980s has altered what economists call the reaction function of policymakers, including Fed Chair Mr. Jerome Powell. Normally, they would be expected to ease the credit as the economies crumbled to limit the damage to the households and corporations. But with the price growth well above their 2% targets, the central bankers are moving in the opposite direction, even in the face of economic contractions, and they are insisting rates will stay higher for longer to stamp out inflation. Though many investors are betting that stance won't persist as the economies buckle and unemployment rises. There is a growing sense among the central banks across the globe that they would rather risk doing too much, Mr. Harris said. They don't want to underdo it and have to come back and hike again later. The danger is that the central bankers will make the opposite mistake to their one last year. Back then, they basically underplayed the dangers of mounting price pressures in economies still struggling after the pandemic. That allowed inflation to get out of control, prompting this year's rapid reversal with huge rate hikes. Perhaps chastened, officials are now vowing to maintain their inflation fight even though the price pressures may be starting to come off the boil, especially for the goods, as economies slow and supply chains unclog. They remain particularly worried about the price expectations ratcheting up and elevated pressures becoming embedded in their economies, much as happened in the 1970s earlier. The longer the current bout of high inflation continues, the greater the chance that expectations of high inflation will become entrenched, Mr. Powell said on Wednesday, that is, on 15th December 2022. President Ms. Christine Lagarde declared a day later that the European Central Bank has longer to go too. One exception is the Bank of Japan, which is expected to maintain its ultra-loose policy settings next week. A new worry globally is the authorities underestimating how quickly inflation can fall as growth slows and supply chains mucked up by the COVID-19 unclog. The threat is that their strict stance could make an already dire situation worse, deepening the downturns that central bankers hope will be short and shallow. If 2022 was a year of inflation surge, rising rates and falling equity market multiples, 2023 is going to be a year about the macro cycle. Joe Little, Global Chief Strategist at HSBC Asset Management, wrote in a report, "We have likely reached the peak central bank hawkishness as the headline inflation rates begin to cool." Bank of England officials openly reckon the UK is already in a recession, and their ECB colleagues assumed the euro region succumbed to one this quarter. Both economies have been hammered by soaring energy costs driven by Russia's invasion of Ukraine. The United States is less exposed to the fallout from the war, but it's still in a danger of a downturn as a higher inflation and rates impact the economy as a whole. Although Powell has shielded away from saying the recession is in the cards, the two of his colleagues penciled in a contraction in the gross domestic product next year in projections released this week. While all three central banks are actually poised to raise their rates further in 2023, the increases are not likely to remain as uniform as this week. Powell left the door open to the Fed scaling back to a quarter-point hike in February, while Lagarde told markets that they are underestimating the European Central Bank's resolve. She suggested at least two more half-point steps are coming and announced the plans to start reducing a stash of nearly $5 trillion in the bonds. Meantime, Bank of England rate cuts are moving into focus. While a majority voted this week to raise by a half point to 3.5%, the two of officials opposed a hike and hinted that the policy should soon be eased. They believe 3% is actually more than sufficient to bring inflation back to target before falling below target in the medium term, the meeting minutes said. So the key focus for all three central banks is in the job market. Unemployment in the major developed economies at 4.4% in the third quarter is the lowest since the early 1980s, according to the Organization for Economic Cooperation and Development. That's pushing up wages, increasing pressure on the companies to jack up the prices. They also need the financial markets on their side. If they ease further, that unwinds some of the higher borrowing costs. The overall message for 2023 seems clear. Central banks will push back on the higher risky assets until the labor markets start to turn. George Sasarevolis, global head of foreign exchange research at Deutsche Bank AG, wrote in a report on Friday, that is on 16 December 2022. The world's two biggest central banks, the Fed and the ECB, have given a clear message. Financial conditions need to stay tight. Hence, they are quite worried about inflation. On the other hand, they are worried about the energy price shock and what that could do to the economic growth. So, he does not want to be in their shoes. That's what he claims. So he reckons the ECB has the hardest job because of the region's exposure to the Russian energy supplies and the vagaries of the winter weather. It looks to him as the Bank of England has the biggest inflation problem, said Mr. Dudley. So with vaccines still abundant, the labor shortages are driving up wages. Regular private sector pay is now growing at 6.9%, the fastest this century barring the pandemic. The UK seems to have the worst of both worlds. Europe's energy price shock and US style tight labor markets. Wholesale natural gas prices have risen sevenfold since mid-2021 and employment is 2 lakh below the pre-pandemic levels. Workers have retired early or dropped out due to ill health. So this situation is actually alarming for the global economy as a whole. For the three banks which we have considered, that is the US Fed Reserve, European Central Bank and the Bank of England. These are the developed nations of the global economy. And now, as we have just seen in our discussion, that the overall scenario is very gloomy, thereby helping us to conclude that in the coming year also the global recession seems to continue. So now, dear friends, now we are going to see how India is being highlighted as a bright spot in the dark room because of its strong economic credentials and very strong leadership, as I have been quoting again and again. So, the forex reserves of India rise $2.9 billion this week to touch $564 billion. India's foreign exchange reserves rose for the 5th straight week. The data released by the Reserve Bank of India on 16 December 2022 showed that the forex reserves increased by $2.91 billion to reach $564.07 billion for the week ended December 9. Reserves had soared by $11 billion to reach $561.16 billion for the week ended December 2. After reaching an all-time high of $645 billion in October 2021, the reserves have been dropping as the central bank deployed dollars to defend the rupee. India's foreign currency assets rose to $500.13 billion for the week ended December 9, up $3.14 billion. This is a very, very positive sign. Expressed in dollar terms, FCAs, that is the foreign currency assets, include the effect of appreciation or depreciation of the non-US units like the euro, pound and yen held in the forex reserves. I repeat, expressed in dollar terms, FCAs include the effect of appreciation or depreciation of the non-US units like the euro, pound and yen held in forex reserves. And the next great news for the Indian economy is this, that the non-fossil fuel sources to fulfill 62% of the energy demand by 2030. India is expected to source about 62% of its energy requirements from the non-fossil fuel sources by 2030, about 12% more than the target. It is so brilliant news. According to a senior power ministry official, India is already sourcing about 42% of its energy requirements from the non-fossils sector. Additional Power Secretary Mr. Ajay Tiwari said at South Asia Power Summit organized by the industry body Confederation of Indian Industry here on 16th December 2022. According to the official data, the total installed electricity generating capacity in the country was 409 gigawatt, including 166 gigawatt of renewable generating capacity, including large hydro as of October 31, 2022. So going by the current pace and the trajectory, India is likely to source about 62% of its energy requirements from non-fossils by 2030, exceeding the target it has set for itself for sourcing about 50% of its energy requirements from non-fossil fuels by that year, Mr. Tiwari said. So there is a sudden hike of 12% in our projections to generate energy from the non-fossils. This is extremely overwhelming. According to the Power Ministry, the country's electricity generation capacity will reach 820 gigawatt by 2030, including more than 500 gigawatt from the non-fossil fuel sources. This reminds me of a famous phrase or the popular phrase in Hindi, that is, "Jahan chaha, wahan raha." The senior ministry official further said that India is actively working towards a vision to have an interconnected power grid across the South Asian region, covering as many countries as possible. India has a very robust power grid running from north to south and east to west of the country. In future, we would like to see the grid connected to the neighboring countries including Myanmar, Sri Lanka, and then expand that connection to the Southeast Asian countries as well to emerge as a unified market, Mr. Tiwari said. A discussion at the intergovernment level is already happening in this regard to strengthen the cross-border grid between India and Nepal and India and Bhutan, he said. Such a wonderful news it is. So dear friends, we have been able to analyze that in this gloomy global economic situation or the global turmoil which is going on, as we have been able to figure out from the statistical figures, the recent statistical figures of the three renowned banks, that is US Fed Reserve, European Central Bank, and the Bank of England, that the global situation is actually very gloomy, right? Suggesting the global turmoil, global recession, especially for the coming year also, the situation is projected to be very, very unfavorable, right? Because of the increased expectation of the rate hikes. And among this gloomy global economic scenario, India is prospering, and that's why India is being highlighted by the entire world because of its strong credentials. So let's maintain the space because we are making good efforts towards sustainable development also, and that's a very good sign. We are not overstating the facts, we are just reflecting what's actually happening and what's actually existing. And what should we be really proud of? Such a great news, such a great news. So let's keep on maintaining this pace, and our role as the citizens of the country is to support our government in their noble efforts, because they are doing and putting very, very sincere efforts, and this time phase is very delicate. So we should not engage ourselves in the short-term criticism or in the short-term oriented gossips. We should be visionary. We should be far-sighted, and we should act maturely. That's my message for all of you, dear guys. Thank you so much. It was a very good session with all of you. Namaskar. Jai Hind.